Okay. Hi, I'm Riley Smith, alumni and annual giving specialist at the David Eccles School of Business here at the University of Utah. We welcome you wherever you're tuning in from around the country or the world. Thank you for joining today's Eccles Alumni Experience Forum. I am so pleased to welcome two market experts who will lead us in a robust discussion regarding a 2022 Economic and Outlook Forum. I am pleased to welcome our moderator, Mr. Phil Dean, who is a public finance senior research fellow with the Kem C Gardner Policy Institute at the University of Utah. Our guest tuning in from New York City is Mr. Nilardi Mukherjee, head of portfolio strategy at Merrill Bank of America. Should you have any questions or comments today, please drop them into our chat. Additionally, please like this video and subscribe to our YouTube channel for similar future events. And now, please welcome Mr. Phil Dean. Phil?
Thanks, appreciate that, Riley, and really appreciate Neil joining us, and we'll come to you in just a minute here, Neil. Just want to start out briefly talking about the last year, a little bit of a recap, and then we can start going into what we expect for the coming year. You look at this last year, go back in time, the Delta variant early on, we're kind of dealing with the surge. 2021 comes in, the economy still, we're trying to figure out what's going on with COVID. A lot of challenges there. And then by the end of the year, we're dealing with significant inflation. We're dealing with labor shortages, very different challenges than what we were dealing with at the beginning of the year. And so it's the way I think of it is 2021 came in like a lamb and went out like a lion. Just very different economic circumstances from the beginning of the year to the end of the year. So with that now, I want to turn to our guest. Neil, very much appreciating you taking the time out of your busy schedule to join us today. Now, I was wondering before we jump in, if you could just tell us a little bit about yourself, your background. I know we're at a university here. Students are always interested in your career path, kind of how you got to where you are today.
Yeah, well, Phil, thank you for having me, and hello, everyone. It's great to be on this WebEx with you. So I'm Nilardi Mukherjee. I am a part of Bank of America's wealth management business in an organization called the Chief Investment Office. And Bank of America, through its various wealth management businesses, such as Merrill Lynch Wealth Management or the private bank, which used to be the US Trust operation, serves individual clients, endowments, foundations, other kind of institutions as well, but mostly individual clients, ultra high net worth, affluent, mass affluent as well, and advises them in for wealth management purposes. And we do that through our network of financial advisors who are all over the country. They're, as I'd like to say, they're the best in the industry as to what they do. And they all have their own clients. And we, as a central resource in the Chief Investment Office, provide them with the knowledge and the tools and the market intelligence so that they can effectively manage their clients' portfolios. As you can imagine, what's happening in the markets in the last couple of days, certainly all of this year, this is the kind of situation where our advisors and our clients need us the most to provide them the right recommendations and to help them through what I would say are pretty treacherous times in the financial markets. I work in, as I said, the Chief Investment Office. My responsibilities are as head of portfolio strategy. I advise clients and advisors on tactical asset allocation, which is, should clients be more focused on US equities, and within US equities, should they be more focused on large cap equities or small cap equities? Are emerging markets looking more interesting? What do valuations look like? What is the outlook for corporate profits? What does the broad economic conditions look like? And how does that filter through into portfolio recommendations? How should we position versus stocks, versus bonds, versus alternative investments, versus cash in a typical portfolio? And we have a team here who are experts at whether it's equities or fixed income or alternative investments, certainly folks who are focused on geopolitical issues and alternative investments, interest rates. We have economists, etc., who help to parse through all that information so that we can provide that guidance to our clients. Now, I've been at Bank of America for about 15 years now. And prior to that, and throughout my time at Bank of America, I've been in the investment strategy function. So it's reading a lot, doing a lot of research, writing, talking to clients, and obviously thinking about ways as to how we can effectively position our clients' portfolios. So I've been doing this for 15 years at Bank of America, but even prior to that, I spent a few years on the buy side in a hedge fund company here in Connecticut, managing a long short equity fund as well as a long only fund. And prior to that, my educational background is that I have an MBA in finance, and my undergrad, believe it or not, was in a hard science field in physics. And I've also worked at in the consulting arena with KPMG here in New York in the accounting and consulting side, and also back in India where I grew up. I worked in the area of infrastructure finance and project finance, which in the 90s, even now, but in the 90s, it really took off in India as a big endeavor. So that's where I'm coming from and what my role is.
Well, thanks. I very much appreciate that. And it's I always enjoy understanding more about people and how they got to where they're at today. So let's jump in. We have a lot of exciting things to talk about, maybe some little bit scary things to talk about in terms of understanding what's going on in the world, what's going on with markets. But let's maybe jump back to that discussion of 2021 and kind of jump in on one of the big things that people are concerned about. This is consistently in the news every single day, inflation. People are worried about inflation. There are kind of, I think, a lot of things underlying that, but just want to get your perspective. To what extent is the Federal Reserve's monetary policy, the massive fiscal stimulus, over $5 trillion of deficit spending by the federal government during the pandemic, how have those contributed to inflation, and what are the other factors that are also contributing to inflation?
Well, great question. And obviously, number one worry for the economy and for the financial markets. Well, I think what happened was obviously inflation at 7.5% CPI levels, consumer price index levels. It's at the highest point since the 1980s. And that's a concerning number. And what's even more concerning is that it is still rising and it's still broadening out across the economy. So it looks like we haven't really reached the top in terms of this inflation cycle. And lately, given the rise in oil prices and what's happening in Ukraine, that only adds to that upside pressure in commodity prices and inflationary pressures. But what's really happened is the core of why we're seeing inflation levels at such high levels is there's just been too much demand and there hasn't been enough in terms of supply that the global economy can provide to catch up with that demand. So the rest of it shows up as inflation. And it's a very different environment than what we had witnessed last cycle, in the previous cycle in 2010 to 2019, 2009 to 2019. You'll recall that inflation was not a problem. In fact, inflation stayed below even the Fed's 2% target for 10 years running. The Fed was never able to achieve their 2% target. And the reason for that is that demand was, for the most part, quite lackluster in that previous cycle. And there was enough supply out there. So inflation was contained. But now what we're seeing is a lot of demand in the economy. And part of the reason that we're seeing that is maybe we stimulated the economy too much on the demand side with fiscal stimulus in terms of all the stimulus money that was put through either the CARES Act, which I believe the CARES Act would have been enough to rescue the economy back in April 2020. But I think subsequently, I think the 1.9 trillion rescue plan in March of last year, I think that was just over the top, in my opinion, in stimulating the economy, which was already doing quite well in terms of coming out of the deep hole from the pandemic in the year previous to that. And supporting these huge fiscal packages was this incredible rush of liquidity by the Federal Reserve into the economy. So, money supply has grown by 40% in the last 2 years. Incredibly, money supply is growing even now by 12, 13% at last click, which is incredible to me that at these levels, the Fed is still adding liquidity to the market. So is the European Central Bank, by the way. And if you have a monetarist view of how inflation works, it's every time we've seen this explosion of money supply in the last 120 years of monetary policy history in the US, we've always seen inflation spike higher. It happened after the First World War, it happened after the Second World War, and it happened in the great inflation decade of the 1970s. And this is the fourth time we're seeing the level of money supply growth that we have seen in the last 120 years. So there's no, the monetarist economist view would be borne out, which is that's the reason that has created the excess demand situation. That's the reason we're seeing inflation at such high levels. So, and by the way, monetary policy works with a 1 year to 18 month to 2 year lag. And to the extent that all this money is going to stay in the economy, even if the Fed is starting to tighten policy, expected to start to tighten policy next month, we could still be with this high inflation numbers, at least for the balance of this year. So we can talk about a lot of other things with respect to inflation going forward and our views and what the Fed could do and what the economy looks like. But to your question, Phil, which is what's the primary reason? I think it's money supply growth and excess stimulation and consumer demand that's led to this situation.
Well, thanks. I want to follow up with a question on that. So, consumers are flush with cash. I've seen numbers anywhere $1.5 trillion, $2 trillion of excess savings sitting there that people have to spend. And then on the other side, on the supply side, we have all of these constraints, right? So we have very constrained supply, ample demand out there for almost everything that you can imagine. And so when people couldn't go out during the pandemic, service consumption just couldn't occur in the same ways that it had prior to the recession. So we kind of have constrained supply, constrained service consumption, and this massive then, like, where do people spend their money? They're going to spend it on goods. And I think there are a lot of factors, supply chain issues. What are your views on supply chain problems? I hear it in the construction industries. I hear it in just regular goods manufacturing. A lot of times it's one or two component parts. They can get everything else, but one key piece of their production line, and they can't produce anything because of that. What are your thoughts on supply chain issues and kind of how you think that piece of this puzzle is going to work its way through?
Yeah, you're absolutely right. Supply chain issues are plaguing every single industry out there. And by the way, when I think about supply chains, it's really the supply side of the economy, which also includes, the availability of commodities and workers as well. That adds to that issues that we're seeing on the supply side and the supply chain side of things. I would say it's a very complex issue. I would say in the near term, say in the next 6 to 8 months, my belief is that as the economy gets to the other side of the Omicron wave, and it's looking increasingly likely that Omicron is now fading very quickly here in the US, in Europe as well. I think you'll see that fading happen in Asia in the next few weeks as well. I think once that happens, then consumers are likely to shift their wallets towards that. Some improvements, for example, retail inventories held by retailers, they have gone up, and in recent months, especially last month. And one of the reasons that is being attributed to that is there's not enough demand right now, and we've done all the retailers have done all the purchasing over the last couple of months, and that's why you see all those ships outside the port of Los Angeles and LA. And so some of that might alleviate itself in the next couple of months. So that's sort of the near-term view. But I do think that there's other big structural supply chain issues out there. So for example, if you look at commodities, which feed into the construction and the manufacturing of all products, especially energy, that is severely constrained. So you look across most commodities out there, whether it's energy, oil, natural gas, or copper, nickel, etc. There's supply shortages, and they're not expected to resolve itself in the next 1 to 1.5 years, especially now with the situation in Russia, Ukraine. That puts Europe in an even bigger bind because they get 30% of their energy supplies from Russia. And Germany gets as much as 50% of its natural gas supplies from Russia. So these things are not going to automatically resolve itself, and it will take some time. Then you hear that, as most of you know, car manufacturing has been stalled or has stalled in the last, I would say, 5 to 6 months for the most part. There was some recovery in the fourth quarter, but they're stalled because of semiconductor unavailability that goes into the car. So there's reports that car manufacturers have built the cars, but it's standing on the sidelines and they're waiting for the chip to come through before they can actually install it and ship it to the consumer. And broadly speaking, there's shortages of semiconductors as well. And as everyone knows, every device that we have these days, everything around our house, our garage doors to our fridges, coffee makers, certainly cell phones, laptops, etc. But everything has semiconductors in them. Semiconductors, I would consider, as the new age commodity. And there's a massive shortage there. And it's not easy to start building and ramping up production of semiconductors. Now, you're beginning to see some firm actions being taken. First of all, the government is focused on rectifying this situation, and they realize that most of our semiconductors production in the global sense happens in Taiwan and South Korea. And given the volatile geopolitical scenario and sort of the US-China trade and technology issues that we have grappled with for the last 5 or 6 years, the US is worried. So they're trying to incentivize semiconductor companies to start factories here. For example, Intel has announced a $20 billion investment to build one of the largest semiconductor fabs in just outside Columbus, Ohio. But it's going to take time for this to come online, not before 2024 or 2025. And similarly, Samsung, as well as Taiwan Semiconductors, has made a commitment to build fab plants here in the US. So this is a much longer term thing. This is potentially not going to be easing up over the next 2 to 3 years. But generally speaking, the situation is getting a little bit better. You are seeing the price of shipping a container from Shanghai to Los Angeles. That's come down pretty dramatically over the last 6 months or so, but still there's a huge issues with supply chain. But I do expect some of that to ease in the near term, especially over the next 6 months.
It is really a sobering thought, and sobering to think of, empty shelves that we haven't seen for many decades here, right? We've just kind of assumed all this stuff happens behind the scenes and it magically works itself out and shows up. And it's kind of, I think, exposed some of the vulnerabilities that exist in our supply chain, some of the just-in-time type processes that do create significant vulnerabilities. So I want to circle back to something you mentioned and relate it maybe a little bit here to what we're seeing in Utah, but we're hearing about labor shortages quite a bit. So I've heard different terms: the Great Resignation, the Great Reshuffling. Baby boomers retiring are certainly part of that story. Here in Utah, we have a 1.9% unemployment rate, the lowest unemployment rate ever recorded here, and mind-boggling that it's below 2%. Can you just talk a little bit about labor shortages, what you see happening there? The question I consistently get asked about this is this just kind of a short-term thing, or is this a more permanent thing because of those baby boomer retirements?
Yeah, it's a great question. And this labor market is unlike anything we have seen in a long, long time. You're right. There's stories about labor shortages across the board in every industry, but especially in the leisure and hospitality industries, where we're seeing much more of these kind of issues pop up. So a few things are happening, right? First of all, we have recovered most of the jobs that were lost in 2020. So there's roughly 2 or 3 million jobs still left to recover. But the job market is recovering very quickly. In January, the economy produced 500,000 jobs roughly. I would expect over the next 6 to 12 months, most of these jobs will be recouped and the job market will be made whole. But having said that, the economy is so strong right now, and consumer demand is so strong right now. Companies need even more workers. And in the coming months, they'll need even more workers in areas like travel, leisure, restaurant, dining, et cetera, because that's what people would want to do when they come out from their, hiding in their shells. And so wages are rising very strongly across the board. We're seeing wages rise by 4 to 5%. Whatever metric you look at, average hourly earnings or the employment cost index that the Federal Reserve looks at. And no question, this is feeding into the inflationary narrative as well. And you can almost see that this is a beginnings of a classic wage price spiral. So in other words, and the good thing is this is still a little bit backward looking from the perspective of the employer, which is employees have seen that prices have gone up, and because of that they have gone back to their employers and said, I need an increase in my wages, and they're getting it. But if you look at the forward expectations of inflation, which is still quite subdued in the marketplace, if the employer now starts to believe that going forward inflation will be very excessive, and if they start to incorporate that into their thinking and going back to their employers and saying, I need a wage hike before that happens, I think that is a classic wage price spiral that the Fed is desperately trying to avoid with its hawkish pivot. The other thing that's happening is when you think about the labor force participation rate, right? So right now, the labor force participation rate is roughly 62%. It used to be about 63% before the pandemic. So there's a little bit of a room for that to catch up as more people start to come back into the labor force and looking for jobs. Some people are still out of the labor force because they're worried about COVID, or they're taking care of somebody who is not in good health, and et cetera, et cetera. And so if you look at the labor force participation rate for folks who are 65 and over, that's about 19%. And before COVID, it used to be 21%. So there's a little bit of a gap there. To your point about the Great Resignation, a lot of people who were going to retire in 2020, 2021, 2022, or 2023 made the decision to retire in the last 12 to 18 months because, and there was a few reasons for that. A, they didn't want to go to work because they were worried about their health. B, they were flush with cash. They had a lot of money that had come in from the government. Or C, because their financial assets and the value of their homes had gone up so much, they felt comfortable enough to not have to work for some time. So they resigned, so to speak, or retired. But they're now beginning to come back again. Folks, the labor force participation rate for those who are 55 and above is starting to inch higher again. And I think that's happening because the government stimulus checks are behind us, the money has been spent, and now you're beginning to feel more comfortable about joining the labor force. And by the way, higher wages are attracting people back into the labor force. So, with inflation so high, people need to get back to work. So I think some of that dynamic is playing out. So I don't think this Great Resignation is a permanent thing. I do think that some of those people, a lot of those people will be forced to come back into the labor force because of everything that we just talked about. And then the other thing, final thing I will say is, or two other things I'll say is, when you look at the number of job openings out there in the economy is at an all-time high. 10 million, 11 million job openings out there, which is roughly, I would say 30 to 40% more than the peak before the pandemic. And that's remarkable. And we only have, like I said, 2 to 3 million jobs, which are still number of jobs, which we still haven't gotten back. But there's 11 million job openings. But the issue there is that most of these jobs require some high-end skills in the area of technology or coding or in the medical field, et cetera, et cetera. And that's an issue which will take a little bit of time to resolve. Now, if you look at folks who work in the travel, leisure, hospitality industry, wages there are typically quite low. And so a lot of people there, the demand for workers is very high right now, but a lot of people there are choosing not to go back. So people who worked on cruise ships or hotels or in restaurants, they're choosing not to go back to those jobs. And again, the research on this is still early, but my feeling is a lot of people who worked in these jobs, which were lowly paid, and they were really hard work because you had to be on your 2 feet all day, and they were hourly wages, and they didn't come with benefits. They're looking at those 10 million jobs that are open, and they're figuring out that if they can just go and get a degree or some kind of a vocational skill, they can go out and get one of those jobs which pay better and give you benefits and have a better career progression, if you will. I think the data on that is still very early, but I think that frictional element is playing out, and it will catch up over the next couple of years. What that means is for some of these areas of the economy like travel, leisure, hospitality, they will have to automate much more because they will not get the kind of labor that they need. And plus, immigration over the very long term, this is my final point, over the very long term, I think the era of excess supply of labor is behind us, or adequate supply of labor is behind us, because immigration has slowed down in this country over the last 5 years. And if you look at all the excess labor that China made available to the global economy, that is drying up as well, for many reasons, because China itself is dealing with peak demographic issues, but also because of US trade tensions. It's becoming less likely that this cross country exchange of labor will be as fluid as it used to be, especially in high-tech fields, that it used to be in the prior couple of decades. So lots of issues there. The cross currents are there, but I mean, I'm pretty optimistic that the job market will remain quite strong, and that feeds into my positive view of the economy. But there's lots of these interesting issues that are trends that are playing out right now.
Thanks for that. We live in interesting times. I'll say it that way.
Sure.
Just so many things going on all at once, right? So we'll go to question and answer here in a couple of minutes. We've had people submit some questions beforehand, and anyone on now that hasn't submitted something, wants to ask, go ahead and submit it in the chat, and we'll get that through. But before we go to that, I have a couple thoughts I want to raise. I want to talk some about the haves and have-nots, and kind of how different people have been impacted. You know, a lot of times in macroeconomics, we're looking at the economy as a whole, averages, the totals, those sorts of things. But there have been a lot of people that have been left behind during the pandemic, and especially some of the ones that you've been talking about at the lower end of the economic distribution. You know, I just look at my own personal example. I owned a home before the pandemic. My home values have gone up a lot. I refinanced my mortgage, so I saved money in my budget because of the low mortgage rates. I was fortunate enough to remain employed during the pandemic. So in terms of where I'm situated coming out of the pandemic, it's maybe different than other people who are renting. And we've seen very significant rent increases here in the US that, in my view, probably aren't fully captured in the CPI measure, the way that they're looking at it. I think it's starting to show up there, but hasn't fully shown up. You look at those who maybe get a used car instead of a new car, that we've had the 40% price increase in in used cars, or people trying to get into a home for the first time. I'm just wondering if you could comment on some of the differences underlying some of the high-level aggregate data.
Yeah, it's a great question, and it's a very interesting observation. You know, I think, and I go back to the actions of the Federal Reserve. You know, they had last year shifted their focus away from inflation and started to focus much more on unemployment, or getting to full employment, and even getting to much broader and inclusive employment issues. So they wanted to keep monetary policy, run it extremely loose, so that everyone who wanted a job could come into the labor force and get a job, and they could get a nice wage hike as well. And then you obviously had the $1.9 trillion stimulus package, and a lot of that money went into you know, folks who really deserve it, and because the economy was struggling at that point in time. But what's happened is, you talked about it, Phil, which is the excess money supply that has been created as a result of what the Fed did and what that fiscal package brought. That's created a huge run-up in home prices. That's added to inflationary pressures. So even though wages are rising at 4 to 5%, on a real basis, after inflation, wages are not rising. And that's why inflation potentially has now become a political issue, because people are saying that they're worried about inflation and their wages are not rising, and you're seeing the popularity of politicians decline. And so all of these issues have happened, and unfortunately, inflation hits the lower income workers' families the most.
Yep.
Because a bigger part of their wallet goes to things like food and gas prices. And all of those things are up 30, 40, 50, 60% over the last 2 years. So this is a real problem. So we started off from a good place where we wanted to help people get through the pandemic, and perhaps we overhelped in some ways. And as a result of that, we are seeing what we are seeing, and that's having the opposite effect of helping people. And then there's long-term consequences, like you said, which is people were struggling to buy homes before the pandemic, because home prices had gone up for 6-7 years before the pandemic. and rents were high. And then the pandemic came, and now home prices are up something like 20, 25%, 30% over the last 2 years. And people who wanted to buy homes are now getting priced out. So they're going back to renting, and you're seeing rents rise, here in New York, 10, 15%, in places like Miami, 30%, Austin, 25%, etc. And people that's a real issue. So it's a have and have not situation. And then you look at, different countries. The US certainly has the wherewithal to go, tolerate this pandemic because, we have all this capacity for fiscal stimulus and monetary stimulus. And we had the technology and the vaccines earlier than other countries had it. But in terms of the have-nots, you have other poorer countries which don't have that capacity to stimulate their economy or keep their economies afloat. And they certainly are way behind the curve on the technology and vaccines. So this is you're right. Generally speaking, the pandemic has created wider disparity in terms of income inequality and also between different countries and regions.
Thanks for that. One thing I fairly regularly hear is, it's nice for the Federal Reserve to ignore food and energy, but in my household budget, I can't ignore food and energy, right? I feel that directly, and like you pointed out, especially those at the low income levels, they feel that most viscerally. Right?
Yeah, and folks, you hear that quite a lot. Where, if I wasn't eating, living in a house, and wasn't driving, I wouldn't be worried about inflation. But the fact of the matter is, for many people, that's 80% of what they spend on.
Yeah. So one more, and then we'll go to some of the questions. But you mentioned housing prices here in Utah on a year-over-year basis, on a one-year basis, nearly 30% increases in housing prices. One of the questions, given the prior recession, I consistently hear is, are we in a housing bubble? Nationally, regionally, whatever. What are your thoughts on a housing bubble?
Yeah, it's a great question. I think the housing market is going to cool down in the very near term because affordability is an issue now. Home prices are up, like you said, quite a bit, and mortgage rates have risen. The 30-year fixed is now at almost 4%, I believe. So all of that is adding to sort of the issue of that affordability is getting to be a problem. So I would expect home sales to moderate from here, maybe even home prices moderate from here. But I do see a long cycle of home construction in this country because we are way undersupplied. Inventories are very low. And this home construction cycle will add to be a tailwind for GDP for the U.S. economy over the next 5 to 7 years. And the reason I say that is the millennials are now aging into their prime years for income earning, spending, saving, and investing. And they're certainly beginning to buy homes. In fact, millennials they were actually delayed compared to prior generations as to when they started to buy homes. But they started to buy homes right before the pandemic hit in 2019. We saw an uptick in first-time home purchases, and they were coming into the market. And then it stopped. And then after the economic reopenings in 2020, there was a surge of interest from millennials coming into buy homes. And I think the number of millennials are a big generation, 72 million. Biggest generation ever. They're now entering that age bracket where home ownership level tends to go up. So they're going into this age bracket of 35 to 45, and over the next 5 to 7 years, and that's the age bracket where home ownership is rises to a 60% level rate versus 30% when somebody is in their 20s. So I would expect strong demand. And I would expect supply is still constrained, but over the next 5 to 7 years, supply is going to be ramped up as they catch up with that demand that is organically going to come through from these millennials. I also think that with the advent of remote working, broadband getting better over the next decade, many people will go to those second tier, third tier cities, which is, I think, a great development. I think it'll ease the congestion on the coastal cities, but it'll give a huge economic boost to middle America and cities other than the usual New York, LA, San Francisco. And you're seeing that already where you are. So
Yep.
I think that's the way these trends will play out.
Well, thanks for sharing that. And in fact, the local paper had an article on millennials specifically. It was interesting, several years ago, you heard this sentiment, millennials just are never going to buy homes. Like they don't care about ownership in the same way that the older generations did. And they'll be fine renting their whole lives. And I think that's become very clear that that's not the case. That whether it was, aversion because of the Great Recession and kind of what led to that, or just financially not being able to be there with student loans or whatever else. They're certainly here locally, they're full bore into the market, and it's going to continue for some time. Well, let's shift a little bit to some of the Q&A questions that we had come in before. And again, if anyone wants to put some in the chat. So this is kind of top of mind with events over the last 24 hours. But one of the questions just relates to Ukraine and what's happening there. What are some of the implications of that, internationally for oil prices? I saw this morning they spiked over $100. Where does that take us? What's happening in Ukraine?
Yeah, it's perhaps one of the biggest geopolitical events to have happened over the last couple of decades, in the opinion of many geopolitical experts. It's hard to say where this is going, but it's very concerning because how the responses after this. Certainly, European countries as well as the U.S. is imposing a lot of sanctions on Russia right now, but it's there's still very, very remote probability of an armed conflict between NATO members and Russia at the moment. Very remote, because people just want to avoid that, not even think about it, not even go there. And many European countries and the US believe, and I think that's correct, that if you impose enough restrictions and punishment and sanctions against Russia, they will finally come back in line and not even think about overstepping their boundaries in terms of a full-fledged invasion of Ukraine. Right now, what Russia is doing is they're just targeting military operations, Ukrainian military operations, and they're not really saying that we are taking the country over. But your guess is as good as mine as far as Mr. Putin's intentions. But I got to say, the last Monday speech that he gave was in many ways very concerning, because he did talk about Ukraine's right to exist as a country independently. He did talk about how Russia has been historically denied and all that, which raised the concern that his intentions are a little bit more grander than even Ukraine. So, we'll see where this goes. And this brings to, there's a lot of concern right now with respect to what China might do in terms of Taiwan. I think that still is a very remote possibility that China will want to move on Taiwan. Obviously, oil prices, you said they're above $100 a barrel. If Russia becomes a little bit more aggressive towards Ukraine and tries to invade the country in its entirety, I think oil prices could go up to $120 a barrel plus. And this morning I saw that natural gas prices in Europe spiked by 40%. Those level of prices in Europe will lead to a recession if they are sustained at that level for any significant time period. And I think many of the European nations are now regretting the fact that they had become so over-dependent on Russian oil and gas to begin with. So I would see a hard decoupling, even if Russia sort of, pulls back and we go back to some sense of, normality and the headlines go away over the next few months. Even if that happens, I think there's going to be a hard decoupling that will happen between Russia and Europe, and certainly, NATO and Russia. And in fact, positions will harden especially on the NATO side. They will become even more. I don't want to use the word aggressive, but I think they'll be even more vigilant on the western flanks or the eastern flanks. So where this goes, your guess is as good as mine. Typically, when you get geopolitical events, they tend to have a short, quick impact on the financial markets and the economy. And then once that settles down, the markets and the economy tend to revert back to the old fundamentals. And the old fundamentals, by the way, are not that bad, which is, the home construction market is good, the consumer is in good shape, business spending is ramping higher. And it's just that, this adds to the inflationary pressure as well. So it creates an even tougher, it's an even tougher job for the Fed now, because the Fed is trying to bring inflation down and trying to make sure that the business cycle keeps running along. But higher commodity prices oil prices makes that even difficult. So it's a complicated scenario, but in the short term, high uncertainty. In the long term, it's a hard decouple between Russia and the rest of the world.
Neil, I'm going to jump in and ask, when you say a significant amount of time regarding that, rapid rise in crude oil prices, and you say that it's not going to be sustainable long term, what's the time frame looking like for that? Can we expect 3 months, 6 months, a year? Any insight regarding, what can we expect moving forward?
Yeah, in terms of oil prices, right? And I apologize for a quick second, my screen blanked out. I think the computer just froze. But I think oil prices will stay elevated for the foreseeable future. Absent a recession, oil prices should stay fairly elevated, because with the economic reopenings that are happening, demand will remain quite robust. More people traveling, more people driving, etc., more production. And on the other hand, the supply is quite constrained. So, the spare capacity, OPEC spare capacity is not much right now in terms of how much they can provide, and they're not willing to provide more. I think they like where oil prices are in right now. They also realize if oil prices go up too much towards that 140, 150 level, that can be a demand destruction scenario, and that can curtail economic growth. So I think their calculations are telling them that if oil prices can stay at 100, 120-ish, that's where they make most of their revenue. So they're not willing to add too much in terms of supply. And then the biggest swing factor in the last decade was the US shale players. They were able to add a lot of supply, and obviously US became the number one producer of oil in the world over the last 15 years because of the arrival of these shale players. But what's happened in the last 3 to 4 years is they have become very disciplined in their approach. So when they get their revenues and cash flows from their business, in previous times they used to use those cash flows in drilling more and get more oil out of the ground, but they're not doing so much of that anymore. They've become much more disciplined. They're trying to maintain strong balance sheets. They're trying to return that cash to shareholders and their investors. And so we don't expect too much in terms of shale oil coming into the market, which tells me that high demand, supply sort of constrained, and that's a recipe for oil prices staying quite high. Now, the swing factor could also be Iran. Negotiations are going on with Iran right now. In fact, they've picked up steam over the last 2 or 3 weeks. I think the Russia situation has something to do with that. If we do get some kind of a deal with Iran, and Iranian oil, which is just on the sidelines right now, comes back into the global energy marketplace, that could ease some pain for consumers, because I think that's probably worth $5 to $10 on the lower side for oil prices.
So a follow-up question to what you're mentioning before with kind of this tension that the Federal Reserve is going to have to deal with these spiking oil prices, kind of pushing prices even higher, than the built-in inflationary pressures that were already there. I've heard discussions of, they could increase interest rates, up to 7 times in the coming year or so. What's your thought on the Federal Reserve and kind of not only with the Ukraine situation, but just more broadly, what path do you think they're on?
Well, I think they're way behind the curve in terms of inflation. We talked about that a little bit. I think they let the economy run hot for too long. I think they did their QE bond purchases for much longer than they should have, and they're still doing it, but at a much lower level than they were. They are tapering those purchases. And as a result of that, they are now way behind the curve on inflation. And so we think that the Fed will hike 7 times this year when they have their next meeting on March 14th, 15th, 16th, they will start the hiking cycle. They're unlikely to start with a 50 basis point hike. They'll probably start with a 25 basis point hike because they don't want to shock and awe the market too much. And then they'll potentially just hike every meeting after that. So they could hike 7 times this year. But what I tell folks is that these inflation or these Fed hike probabilities will keep changing over time. And it'll really depend on incoming data on inflation. We talked about one of the reasons why inflation will remain high. It's all the money supply. But I'll give you a little bit of a historical nugget, and I'm not saying this is how it's going to play out, but it may, because nobody knows. Things are so uncertain right now. What we're living through right now is very similar to the situation right after the Second World War. So after the Second World War, from 1946 to 1948, inflation spiked higher to double-digit levels, 15, 16, 18% CPI. The reason for that is coming out of the war, there was excess demand, there's pent-up demand from consumers, similar to today. And supply was constrained because a lot of factories had been retooled away from making everyday goods to creating and manufacturing things that are needed for the war. So supply is constrained, demand was high, inflation spiked. But what happened from 1948 to 1950 was very interesting. Inflation dropped on its own, and goods inflation actually for a very brief period of time turned negative. And the reason for that is all the excess demand was spent, so the demand situation moderated, and the factories came back online. And so supply caught up, demand was lower, and CPI came down. So the Fed is hoping for that, right? They're hoping that they don't have to aggressively hike and engineer a major slowdown or even a recession down the line to get inflation back to the 2% level where they would ideally like to see it. And so we don't know the answer to that. So yes, right now it looks like the Fed is behind the curve, and they might have to be aggressive. So 7 hikes makes sense to us. But keep in mind, the inflation dynamics will dictate how hard the Fed has to go. And 7 might be less. They might have to hike more if inflation further accelerates from these levels. So we'll see where it goes. And in addition to Fed rate hikes, they will also shrink the size of their balance sheet. So their balance sheet is almost 9 trillion right now in size. Before the pandemic, it was 4 trillion. And shrinking the balance sheet, the Fed and the market participants still don't understand fully well how that impacts the broader markets and the economy. So it'll be a bit of an experiment when they do that. But what they do realize is that they have to do it. So they may start the process sometime during the summer of this year to do that as well.
Just as you were talking there, it just reminded me of the saying, hope is not a strategy, right? So it'll be interesting to see how all this plays out. So we have about 5 minutes left. Just want to ask 2 questions that are kind of separate, but also maybe somewhat related. The one is, what do you recommend for people in their household budget and their household investments what are the things that they should be thinking about? And then the second part relates to things that many people are thinking about is cryptocurrency and what's going on with cryptocurrency. Is that sustainable in a regulatory environment? Just your views on cryptocurrency.
Yeah, so investments, I do think that we are recommending to our clients to stay the course and to remain invested and not to go into cash, because the environment looks so fraught with danger, because cash is a losing asset automatically, because of 7% inflation, you're losing 7% right away. So you should look to be in those asset classes which have a history of outperforming inflation, so giving you real returns, and equities happens to be that asset class. So we are advising our clients to stay invested, number one. Number two, this is not a time to take too much risk in any one instrument or any one area of the market. And it's not the time to get too cautious on the other hand as well, because the risks are quite balanced. And number three is, I think dividend growth like strategies will work in this environment, because dividends over the long term have contributed roughly 40% of the total return of the S&P 500. But in the last 3 years, people forgot about high quality dividend growth strategies, because the capital appreciation of the market was so good. That S&P 500 is up 100% in the last 3 years. But I think going forward, as the index sort of stays flat and choppy, dividends will provide you some excellent opportunities to earn that income on a total return basis. And I also think that people will have to consider alternative investments in their portfolios, because these traditional asset classes like equities and bonds, the expected return on them is lower going forward than what we have received in recent times. And so accessing those alternative sources of risk premium, as they say, is going to be important, whether you try to access those kind of alternative investments which give you access to enhanced return strategies, or to hedged strategies, or to inflation protection potential like commercial real estate, or even yield-based strategies. I think that's an important consideration for portfolios. In terms of cryptocurrencies, look, there is two aspects to this whole crypto world, right? One is where people think about trading these tokens. So whether it's Bitcoin or Ethereum or anything like that, that is purely speculation, right? So when somebody says, the price target is X of Bitcoin or this, it's hard to value these kind of tokens, because they don't have the traditional cash flows that other investments have, where you can discount them back and say, okay, this is what they should be fairly trading at. So they're all based on supply and demand. And when people are enthusiastic and they feel like they can take a lot of risk, they have money, these things have gone up. And when the liquidity environment changed over the last month or so, these things have come back to earth. So that part of it, I feel, is speculative, but the underlying technology of blockchain is just quite transformative, because, and that's what people say is Web 3.0, which is, Web 2.0 was all about, social media, us connecting on the internet, work processes getting better, but your data was owned by big centralized companies. And the goal of Web 3.0 is that you will have more ownership in the internet going forward. And I think it creates exciting possibilities, and the use of, and the way to think about this is, when you think about a Bitcoin or an Ethereum or a Cardano or a Solana, don't think of them as a coin or something you can buy and sell. Think of them as operating systems. And very similar to, you would think of Windows for Microsoft as an operating system, or Apple's OS operating system. you have this operating system or platform on top of which applications can be built. And that's the way to think about it. So as of today, there is billions and billions of dollars that venture capital money is going into of the building of these applications. They're trying to make these operating systems much more efficient and less costly to transact and to improve their security features. And I think over the next 5 to 7 years, you will see an explosion in this technology, and a lot of industries will benefit from it because they will adopt these to become much more efficient in the sense of how things move around and money moves around. I'm very optimistic on the technology. Again, I'm not an expert in it, but from what I read and hear, and our analysts are telling us, once you start thinking of them as an operating system on which investors and developers can start building applications, that's a game changer. And I think that's where we're going.
Well, thanks for taking the time to join us, Neil. If you ever get the chance to come out to Utah, I'd love to connect with you again, and look forward to seeing it. And with that, turn it back to Riley.
Absolutely. Thank you to you both for joining us today. We are so grateful for your insights and expertise regarding what we can expect in 2022. As a reminder to those of you viewing, March 1st and March 2nd are You Giving Day. We would love for you to support the David Eccles School of Business as we are now accepting donations. The information will be available after this presentation if you just stay tuned for one moment. Every penny counts, and we are so grateful for your support. Also, if you do donate, you will be entered into a raffle to win an authentic Rose Bowl football helmet. So really exciting. If you are not already, please follow us on social media as we are excited for a variety of events this spring. I'm your host, Riley Smith, and I thank you all again for joining us today. And as always, go Utes.